All right, guys, good afternoon. This is Anthony. This is generally our Tuesday, 11 o'clock coaching session that the inner circle of elite guys have and get. And I do a trading room every day. Let me turn down, hold on, trade the news. These guys are, I had them up pretty loud during the day, and that's the news source that I use and a lot of people use. And something I want to talk about in a second. But again, 11 o'clock every Tuesday, I do these coaching sessions, and I've been doing them for 4 or 5 years. Then we do the daily trading room. And I wanted to get Brett Steenbarger in, and we figure we do it later after the close. And obviously, it's a good thing with the last couple of days, last couple of weeks that we've had. And obviously, this is a perfect topic, and we made it because of all this uncertainty, and that's the title. And then a lot of this webinar is going to be most of the heavy lifting is going to be done by Dr. Brent with questions. I had a couple people email me questions, and I want you guys to not right now, but have some questions that you want them to answer. What I'll do is I'll type the questions on a whiteboard so everybody can see the question he's answering, and then he'll go off and talk about some stuff with each question, I would imagine, but then also be able to talk a little bit about uncertainty first. I'm going to talk for the first 10 minutes or so, and then he's going to jump in and take the torch, and we'll just banter back and forth. So I want you guys to know a couple things. The way I start these sessions off typically is to talk about what's happened the last week. Well, a few things happen, as we know, and almost unprecedented things. I want to first go over, let's make this word, let me throw my pen on it. Let's make this word certainty, because if it's only uncertain, then you should got to stay on the sidelines. If you want or have had, this is the best way to put it, and this is what I've tried to tell people. Anytime there's this explosion of volatility, throughout my career, 20 years being in the screen, and a few years before that, these are great opportunities if you know what you're doing. They're disasters if you don't. So people who have struggled and never made money in normal markets really do have to sit on the sidelines or trade these micros really small and not let the money matter, because these have blown out accounts. Days like this, weeks like this, have blown out accounts of people who have struggled going into volatility like this. And your eyes get big. You get the grapefruit eyes, as I like to say, when you see all this price action and all these big ranges and all these big moves, and invariably someone says, if I would have sold it there and bought it there, I would have made a lot of money. And then if I would have put 2 lots on, I would have doubled it. Then I could have bought it there and sold it here, and look how much I could have made. Look at all the leverage I get. Obviously, your eyes get bigger than your brain pretty quickly, and you get worn out, and you get that kind of look to yourself. You're not angry. You're just dumbfounded or dumb. You got to put yourself in a position to anticipate what's going to happen next, and let all this fear fall around you. That's what creates volatility, is the F word, but followed by EAR. All right. Now Sunday going into Monday, unless, a lot of people don't realize this, it wasn't just coronavirus. It was Saudi Arabia giving Russia the middle finger and saying, okay, you don't want to cut production? We're going to increase production. And that created just this incredible price war with oil and these OPEC nations and Russia. And we went down, about 25% Sunday night into Monday in crude oil. Now, people would say, well, that might be good for gas prices and everything else. But listen, the energy market represents, I don't know the exact percentage, but it's the number 2 weighted sector in the S&Ps. So oil goes down, energy sector goes down, S&Ps go down. They're already on eggshells with this coronavirus. So yes, the domino started by the coronavirus with OPEC getting together, wanting to cut production because demand is sinking with all this fear. And so they say, hey, let's cut production so we could stabilize prices, right? If you cut production along with, supply along with demand, you keep prices steady. Russia says, no, we don't want to do that. And Saudi Arabia said, okay, we're not only not going to do it, but we're going to increase production. And that obviously sent oil prices where they sent them. And it affected the energy index or sector. And therefore, it set everything off down 2,000 Dow points, all the limit downs yesterday and everything else. Now, what do we anticipate? That was difficult to anticipate Friday going into Monday, by the way, that Saudi Arabia was going to do that. All right. But how do you create some certainty? And I'm not saying trying to be perfect, trying to be exact, but how do you create some semblance of, I don't want to be the guy not knowing what the hell's going on? And that is anticipate. I started tweeting that phrase, anticipate before you participate. Anticipate what? You got to anticipate what might come on the headlines next, drop down the wires next. For you guys that just joined us, Dr. Brent's going to be here in about 5 or 10 minutes. I'm kicking things off, and then I'm going to give him the torch at about 3:45 Central. But going into what's going to come out, drop down the wire, we call them tape bombs. Started back in the prop days. When something hits the tape, that changes the sentiment in the market, bearish or bullish. All right, overnight, they sent the futures up 1,000 points, the Dow. When I say us, the S&P's up over 100 handles because President Trump said about payroll tax cuts and all kinds of stimulus. They're just trying to create any kind of hope that they could provide the stimulus that'll pull us through. All right. It doesn't help that state of New York brings in the National Guard, that they uptick the cases in Massachusetts and in the Boston area. All right. So until you get this with this coronavirus, with true statistics, which is the peak of less and less cases, all right, there's going to be this uncertainty that's going to be hard to trade until you get a little certainty of some tape bomb that sends us up or down, or some quick reaction to an ancillary. And I can't stress this enough. How could you predict without having it feel like a good guess? And I'm going to show you an example early this afternoon where this happens a lot, especially when things are moving fast. The faster prices are moving, the better chance you're going to get a leader in an ancillary. All right. We talk about this all the time, and edge guys know what I'm talking about. Bonds go down, stocks go up, vice versa. Yen goes down, stocks go up. Not always lead lag, but sometimes. Especially in fear, this relationship works. And I'm going to show you the charts in a second to give you a nice visual of it. But just going back to this coronavirus and the fact that you got to peak, and in order for things to get and seem to be a little bit more clear. Of all Mondays, I had to be in New York and missed some of it. I did a couple small things because I only had my laptop, so I don't have all my tools. I'm real careful, but I was speaking at the Trader Expo. It was surprisingly well attended. I did it for the CME. They were sponsoring an area, and so I went and I spoke to a lot of guys that, I don't want to get into the crowd that was there. Some are serious and some are not. I think just like anything else. But I was surprised that the attendance was good amid everything's going on. And I didn't see any panic there. Didn't see a lot of masks. I didn't see a lot of anything that would have been concerning. However, I go to the airport this morning, LaGuardia, and it's empty. There's no line at the TSA. And I asked the guys, is this normal? They go, nope. No lines, nobody behind you, nobody in front of you. It was like it was closed, and I was the only one there. Now, there were people at the airport. The plane was mostly full, but as far as like crowded, it was the opposite. So I'm not saying there's panic, but I am saying that we're not past the F word, the fear, and we still got a ways to go. If China, and we had dependence on data coming out of China, and hopefully this stuff is helping you guys because it's got to allow you to anticipate what's next. If the data out of China could be relied upon, if they didn't 2.5, 3 weeks ago, which really kicked off all this downside, had to use the word mischaracterize the data and the cases that they were reporting, which is another word for lying, I don't think we would be down as much starting 2 weeks ago. But once the unknown became, well, how bad is it? And we can't trust them. That's what happened 2.5 weeks ago. That was the real downside. The point I'm trying to make is China's already had the other side of that peak, it seems like. They're reporting 20 or 30 cases, and those were hundreds of cases per day. And they're down to 20 a day. And so it seems like they're having diminishing returns, which is what you see when you're on the other side of this thing. But again, they're not to be trusted, so we don't catch a bid necessarily on that. Now, there are people out there that'll be like, regular flu kills 25,000 people or 25 million get it. And I get that. I understand people that come from that camp. But you got to remember, the markets are, if they don't agree with you, you're the one that's going to lose. So you can't be stubborn with your general opinions. Got it? Don't be stubborn with your general macro opinions about this. Whether you're extreme to scared to death or extreme to, it's no big deal. Don't be either side. Real quick, because Dr. Brett's about to come on, and I want to give him the leash, and I just wanted to cover some of the things that through all these years of trading volatility, if, again, volatility is opportunity only if you know what you're doing and you can anticipate. So I encourage everybody to know what to anticipate as far as the headline. Right now, Speaker of the House Pelosi said that Democrats might put something together. I think that's important. I think the markets want to see them work together. That's what's going to be important coming out of Washington in the next few days. Do they have something together that creates some sort of tax relief? Something, whatever it is. The markets are almost pricing that in with a relief rally today on it. And then, is there any plateau with the reported cases? Doesn't have to spike lower, but is there a plateau so you could kind of calm the fear? Because the reality is, if I'm an older guy or older woman, just a little more serious, and you want to keep yourself probably away from crowds. But if you're not over 60 or 70 or 80, it's maybe just like the regular flu season, right? But the perception is not that reality. That's what I mean by your opinion or my opinion, like this is just a flu. While that might be true, perception isn't that just yet. All right. And so that's what I wanted to kick things off with. Let me find Dr. Steenbarger and bring him in, and then we can go from there. I want you guys to start typing in some questions now, and then I'll go back over them, but I'm going to bring in Brett and have him test his mic out first. I want to show one chart after I bring you in, Brett. Let me find his it helps when I could find names here. Did you call in, Brett? Oh, he said he's I think this might be him here. Take your time, type in your questions, and I'll open up his mic. In the meantime, let me pull down this chart. If you got questions for me, that's fine too. I'll answer them, but I prefer we angle them towards. Let's get rid of this. Let me show you this chart real quick. Here he is. All right. Dr. Steenbarger is going to be, if you just came here, you just arrived, Dr. Steenbarger is going to be talking in about a minute. He's going to answer questions. He's also going to talk a little bit about the title of this. But I want to show this chart really quick on just an example of today. This upper chart here is the 30-year bonds. Real simple. They didn't just go down in this 2 or 3 minute period. They went down pretty fast from like 182 even down about 10 ticks. And if you look at it, it was a leader to a rally that you got in the S&Ps. What's important, whether it's to get you into a position, all right, or validate and keep you comfortable when you're in a position, are what the correlations are doing. If you're long and you're going to ask, how can I time out my exits better or feel comfortable when this market's moving around? What are the bonds doing? What is the Japanese yen doing? If those markets are weak and going down and you're in a long position, you could tend to be more comfortable. But just like the market, it's moving faster. Your decision-making process has to move faster, but in a calm state. All right, let's bring in Dr. Brett. Allow to talk. I'm just going to give you an open mic. Brett, let me know if we could hear you.
Hi, can you hear me now?
Sounds good. How you doing?
I'm doing fine. Thank you very much, Anthony.
I held everything up for you and just talked a little bit about anticipating what the next headline could be for more relief and more of a rally. But there's a lot of questions that are coming across. How do you want to handle it? Do you want to talk a little bit about the title of today and then roll into questions? What do you think?
Yeah, let me just make some observations on the current market situation and the things that I'm discussing with hedge fund folks and with healthcare professionals, and just toss out a few ideas, conclusions, and then we can get right to the questions. Does that sound okay?
That sounds perfect. What I'm going to do is I'm going to put up a whiteboard and I'll just type some things bullet point things that you're talking about. So for people that just joined, this is Dr. Steenbarger. You guys know mostly about him, and I'm not going to give his bio because you're probably here because you know that bio, you know about him. So I'm just going to hand you the leash and you the torch, and then just write some things on this whiteboard. Can everybody see this whiteboard? You don't have to see it, Brett, but they can. Perfect. All
Good.
right. We'll just keep moving. All right,
Okay.
Brett, go ahead, buddy.
Okay, so I'm just going to run through a few topics, and then if you have questions about those topics, I'm happy to entertain those. The first topic is, what does science tell us about the course of this coronavirus and the implications of that course? As you pointed out, this is not a simple flu epidemic. This is much, much different. All of the research that I am hearing, including epidemiologists who are being consulted by large hedge funds, biostatisticians, the conclusion is that the course of this viral condition is exponential. It appears first in a few cases, then in tens of cases, then in hundreds, then in thousands. The spread is exponential. Then that exponential spread is followed by a rapid decay in the number of new cases. The key factor in how quickly we go from exponential increase to rapid decline in new cases is a function of public policy response. The quicker countries are and locales are to button down and enforce a high degree of social isolation, the quicker the exponential increase finishes and we get into that decline mode. The longer it takes for effective public responses to the situation, the longer we continue in exponential mode, and the greater the damage, the greater the strains on the healthcare system, the greater the strains on economies, and so forth. And so, for instance, in countries that have had very strong responses, China and Taiwan come to mind, the number of new cases has been on the wane. In countries like Italy, which as an open democracy, it's harder to have that kind of response. We see quite an expansion of cases. My concern, and the concern of the people I talk to, is that the responses so far in the US are quite lacking. That very recently we're seeing some public response of a strong nature. New Rochelle, New York is undergoing that thanks to some orders from Governor Cuomo. We're also seeing universities shut down after spring break and hold classes in online mode. You know, this is all to create that social isolation. In general, however, you don't see the kind of concern, you don't see the kind of holding back that is needed to prevent that exponential spread. And so the thought is, among the smartest people I talk to, that things could get significantly worse before they get significantly better. And that could have real implications for the economy and real implications for markets. What we don't know, as you pointed out, Anthony, are what the responses will be in terms of central banks, in terms of national policies to help troubled industries, sort of like TARP in 2008. And the thought is we could see some significant QE, we could see some significant efforts to provide liquidity to the financial system, which could be supportive. But my observation is that as long as this virus situation is getting worse in the US, it is difficult for money managers to be heroes and start buying values. We're also seeing concerns in credit markets. If you look at high yield debt, particularly because of the energy situation, the price war between Saudi Arabia and Russia, impacting energy firms, exploration firms, many of those firms issuing high yield debt. And that is on the radar for the money managers I speak with. A third thing on the radar is the uncertainty around the election. If you look at the Real Clear Politics summary of polls, currently Joe Biden is leading Trump by 6.5% on average in head-to-head polling. We could see quite a change of leadership in the US, which means a change in policies and a fair amount of uncertainty around that as the Democrats need to reach out to the supporters of Warren, the supporters of Sanders, in order to energize the base and get people out to vote. And so there's a lot of policy concern should that happen. My own view, for what it's worth, is that ultimately, if this virus situation gets much worse, the current government is going to be blamed for not protecting its citizens, and we could see an electoral rout in November. To shift gears, I did a historical study of occasions like yesterday where we have a large number of stocks making fresh 52-week lows at one time. Yesterday, the number was slightly over 1,000. I went back to January of 1997 and found only 39 daily occasions where 750 stocks in the NYSE universe made fresh 52-week lows at the same time. Those occasions, those 39 occasions, clustered in 2008 and in 2011. We also saw some in 2007 and 2009, but they tended to cluster. And so the point I made to the portfolio managers that I speak with is that when you see extreme weakness, it's a little bit like seeing a cockroach in your home. Usually there's not just one. And so the presence of real weakness does not necessarily mean, oh, it's a panic, we should be buying the dip. In fact, the course of prices after these kind of big routes has been rather uncertain. Over a next 5-day period, there tends to be rally. In fact, there were 30 occasions up and only 9 down for an average gain of over 3%. So over the next week, you tend to have a bounce, just like we saw a bounce today. However, if you look 80 days out, you have a much more even picture of 19 occasions up, 20 down, flat average returns. But during that 80-day period, on average, you get moves higher, averaging 12%, and you get moves lower, averaging 12%. So the big takeaway here is that when we have this extreme weakness, the real winner is volatility. We tend to have significant moves on either side of the market. And that is why the traders and portfolio managers that I work with, who have been most open-minded, most flexible in their trading, and most proactive in taking profits, have been the most successful. The ones who get locked into fixed opinions about we're going to bounce or we're going to go to zero, those are the people most getting hurt in this volatile environment. One last thing very quickly, liquidity in many markets is going really down, and people managing large amounts of money recently shared that with me. And so that illiquidity contributes to the extreme volatility, and that doesn't look to be changing in the near term. That creates psychological challenges for us because there is opportunity, there is movement, but on the other hand, it's easy to get distracted with so many things moving, and it's easy to get locked into views and go through some painful reversals. So with that, I'm happy to open the door to any questions you might have, whether it's about trading psychology issues, about current market issues, about some of these healthcare issues, whatever could be helpful to you.
Brett, let me start by saying, so this is worse than the flu because it spreads faster than the flu. It's more contagious.
Okay, so it's worse in a couple ways, and it's very significantly worse. One of the big differences is that people can harbor the virus, the coronavirus. People can be infected with it and not be symptomatic for a number of days. And so that's why sometimes you're hearing, well, if you have symptoms, don't go to school or don't go to work. That is incredibly stupid. A number of days pass while someone contracts the virus before they become symptomatic. And during those days, they are passing the virus to other people. And so there's a whole period of contagion going on where no one is symptomatic. And that's what makes it so dangerous. So it's very easily contracted and it's stealthy. And so it can spread quickly before people are even aware of its existence.
Wow. So when you say, once you have the symptoms, you've already spread it. Once you think,
yes. Oh, yes. Once someone in your environment has symptoms, then you go into quarantine. The presumption is that you could be infected because of those dynamics. And that's really different than SARS and other situations that we faced. and it's explaining why there's been this exponential rise in cases once the first cases show up.
Do you feel like they're trying to downplay the fear? Not in the media, I'm talking about publicly. Do you feel like they're, because I haven't heard really anybody say what you said. That's much worse than the flu and in this way and that way.
I think it is incredible how people are minimizing this.
Minimizing it. I agree, because
I think, and some of that is by conscious design. I think that public officials don't want to panic the population. I think that public officials also think that if they put a rosy face on it, that markets won't go down. But people in general are thinking, well, okay, I'll just stay away from certain situations and I'll use some hand sanitizer. That's totally not where things are at.
Yeah. Well, I think that people tend to minimize it. I've minimized it for a while. And what gets me to say, well, wait a second, the markets never generally get it wrong. If there was something to minimize, the markets wouldn't be where they're at, or they wouldn't react so wildly like they do. So they're not minimizing it.
If you look at my Twitter feed, it's at Steenbab, Steenbab, at Steenbab. On my Twitter feed, I linked to a translation of some news reports coming out of Italy that illustrate the situation that's developed there and illustrate the impact on healthcare systems, on people's lives, and so forth. And if we do not institute strong measures of prevention quickly, I mean, hell, we don't even have tests out there. The negligence, in my view, is criminal. We don't even have tests available in healthcare centers. If our response is not a vigorous one at a public health level, why would we not be like Italy? Why would those news reports eventually not apply to us? People are not asking that question or considering that possibility.
Well, I mean, if you don't know when it started in China, so why couldn't it spread as much as it spread there? You know what I mean? Here, and it did, to the tune
right.
of
And in China, I mean, it first showed up in late December and early January, and there was a period in which Chinese officials did not make an effective response and tried to downplay it and actually punish people for talking about it. And during that time, 5 million people left the Wuhan area, partly because of it being a holiday period. And that was instrumental in creating spread. It's the lack of an effective public response that allows that exponential growth to continue unchecked and eventually devastate the population.
So where are you at, in Connecticut or New York?
I'm in suburban Connecticut.
Do you feel they're minimizing it in New York, or they finally kicked it into gear because they called out the National Guard and in certain areas and stepped it up?
They called out the National Guard, and they're cordoning off one area within New Rochelle that's been a real hotbed. And that is a stronger policy response from the governor. And universities shutting down, and I think we'll see more public events shutting down. That certainly is a response. Will it be enough of a response? I don't know. But I think it is very recently being taken more seriously.
All right, let's flip it around. What's good about this virus? The death rate's low, or let's not say low, but not super high.
The death rate is much higher for people over age 60 and people with chronic health conditions. The death rate is low in terms of percentage of people infected, but because it is so transmissible, more and more and more people are getting infected. And so even though you have a small or seemingly small percentage of people dying, because it's affecting so many people, there can be a large number of deaths.
Right. So just like, anything, when someone who's got underlying health issues or someone that's elderly, they're more fragile anyways. And I don't want to try to act or talk like a doctor because I'm not. But I think that the markets, when you look to minimize something, or if you think that the media is sensationalized something, which they often do, or the government's downplaying something, which they often do, always look towards the markets where people put their money where their mouths are or take their money out. That's telling the true story. So I think you did a great job explaining this. And I always default to the market, because if the markets minimize it like I did, and I'm not saying I minimized it in my trading, I minimized it in my psychology, right? In my, how bad is it?
Right.
Because we broke when this first kicked off, and then we re-rallied and almost made higher highs. Kind of like they did in August and October of 2007. I don't want to get into that, but they broke in August, re-rallied in October 07, made new highs, and then, you know what? Fell off the cliff. Now, this is a whole different thing, but that was where I'm like, all right, thinking of minimizing it was the right thing to do. And then all of a sudden you get all this new information, and the market absorbs it, and the smart money is the smart money for a reason. And when you start slamming it like this, and then you get this price war, which is almost unprecedented. I know they had a big move in 1991 when they liberated Kuwait, but when you get that, and people have to realize how much that affects energy companies when you get oil prices going down 25% over the weekend, and how they have to not just work around. It's hard. They're not used to that. And so there's a lot more that goes underneath with credits, and I mean, there's a lot at play when the what hits the fan and markets do what they've done over the last really 48 hours. People are not prepared for it, and it becomes a domino effect. And even though the economy is super strong going in, it's always fragile. So, and then you make a good point, and I've said this right along, doesn't matter your political preference. The market doesn't want Trump to lose because of the uncertainty of who's next. That's all. And now there's a better case of that. So that's part of the decline. And you mentioned that. So all these things are big bullet points.
Uncertainty, absolutely. But the other part that we don't know is, will central banks come up with a coordinated response? Will the U.S. government come up with a stimulus package to be able to counter the recessionary impacts of the virus condition and the drop in markets and the oil price war? So we don't know what the policy responses will be at those levels. There's public health policy responses, but there's also monetary responses and fiscal responses. And we don't know what those are going to look like. And there could be an effort at some shock and awe to provide so much liquidity for the markets and for the economy that could really impact markets. That's on the radar for the people I'm talking to.
Yeah, and they cut half a point. They are pricing to cut 3/4 of a point more. There's a lot that they could do. There's no doubt. And don't bet on the end of the world. It only comes once, and you're not going to be around to collect. I'm not telling you that. I'm telling everybody that. I heard that back in 2008. And so we just have to be cautious. And I think you used the perfect word, minimize. Don't minimize it. You have to. You don't have to set your hair on fire, but be careful if you're going to minimize it, because I don't think that you got to be flexible. Just like in the market, you got to go from bullish to bearish pretty quick. So you have to be flexible with how serious this is, and if that point, that pivotal point where they get it under control, whatever that is, we'll know it, and the markets will verify that. Look to the markets for how bad this is. would be my suggestion. They're the ones that are going to cut through the BS, unlike the government and or the media. All right, let's get, if you don't mind, what I'll do is I'll put these questions so everybody can follow along.
Very good. Very good.
And then what time do you got to get out of here, Brett? And then I'll make sure that they have somewhere to send their questions if we can't get to them.
Yeah, certainly. I have until 5:30, so.
Okay.
Yeah.
So let me get to the top. All right. You see my whiteboard, Brett? Or no?
Well, I just see what you've written.
All right,
I don't see any questions.
I'm going to paste one in right here, and I'll read it to you. It says, Dr. Steenbarger, you mentioned emotional awareness and emotional creativity are required for transformation. Because of my own adverse childhood experiences, I struggle with bottling up my emotions. What could you recommend to help my emotions flow more freely during trading and otherwise?
That's a great question, and that's a very good example of how emotional issues from our personal lives can creep into our trading lives. And I do think that there's a role for being in counseling or therapy to work on these very issues. There are techniques available where people can learn to identify their emotions, experience their emotions, and do it in a safe context and do it in a context that provides some insight, some new awareness. And those techniques are really helpful. For the person asking this question, if you would like to take down my email address, Steenbab, STEENBAB, @AOL.com. I would be happy to steer you in some directions I think could be useful. What you want to make sure is that emotional reactions that you have in the markets don't trigger emotional memories from your past and cause you to overreact or react in inaccurate ways. That's the nature of traumatic stress, that past emotional events can creep into our reactions in the present. And again, there are some very worthwhile techniques for working on this that have been found effective in the outcome research. Please email me and I'll be happy to steer you in some good directions.
All right, great answer. All right, next one. Given the environment, are traders at SMB reducing size and scalping more, or are they scaling up to take advantage of the volatility?
Okay, I do work with traders at SMB. I'm not an employee of SMB. What I can tell you is that different traders are approaching the situation differently. I think the key word here is scalping, that the traders who are doing the best at SMB, as at other places where I'm working, are being very opportunistic, move to move, not getting caught in big views. And they're able to make some good money with reasonable size, but they're not getting locked into views, locked into positions. So the key here is more the scalping, the active, flexible trading.
How does an experienced trader develop a trading plan based on your personality and beliefs? I know that's maybe pretty general. How does an experienced trader develop a trading plan based on your personality and beliefs?
I think if you develop a trading plan based on your personality and beliefs, you'll lose money. I think it's the wrong question. You develop a trading plan based on objective opportunity in markets.
That's well said.
And then once you have uncovered or identified objective opportunity in markets, then you will tailor a way to trade that opportunity that may fit with your personality. So for instance, there are some people who do better trading very actively in and out. They process information very quickly. And there are others who do much better thinking deeply and holding positions longer. But the trading plan has to begin with the objective opportunity you perceive in the market. It doesn't begin with you. If you're just trading the way you want to trade, that doesn't guarantee that there's any objective opportunities that you'll be able to exploit in markets.
What do you suggest for someone who gets so anxious that their mind goes blank and they can't think straight about their rules and what they're looking for entries?
It depends on the situation. It's a great question. It depends on the situation. Many times people get that anxious because they are trading too large compared to what they are ready to accept in terms of P&L swings. And so that is why we start developing traders in simulation mode, help them become consistent in their trading, and then very gradually step into live trading and build up their sizing gradually so that they retain their consistency. Many times, if they try to size up too much too quickly, the P&L volatility contributes to this anxiety. Now, on the other hand, we do know that a meaningful percentage of the population, it's roughly 7%, suffers from diagnosable anxiety disorders and mood disorders. And so there are some people who not only have anxiety problems during their trading, they have anxiety problems during their non-trading lives. And there are approaches to therapy called exposure methods that are very helpful. If you look at my blog, Trader Feed, there are some articles on exposure methods. There are also medications that are very safe and very helpful for managing anxiety. One class of medications for helping performance anxiety that's often used by performing artists are beta blockers, which are actually heart medications, but they end up having an impact in slowing the body down and helping control performance anxieties. So it depends on the situation, but you want to make sure that the way that you're trading is not artificially creating anxiety. If you have significant anxiety in your non-trading life as well, then you want to get some professional help for that.
How do you control OCD in overtrading? Having to be in a trade, why?
Well, I don't know if people are using, it's a good question. I don't know if people are using the term OCD in an accurate clinical way. If someone actually does have obsessive compulsive disorder, then there are very effective treatments for that. It does require professional help, and typically it would be a combination of behavioral therapies and medication. And so I recommend going to a specialist and getting a diagnostic workup and seeing if this truly is a problem. The way you would know is if the obsessions or the compulsions are cropping up outside of treatment in your personal day-to-day life. If so, then you really want to get professional help for that. And the rate of success with the right kind of behavioral therapy combined with the right kind of medication is quite significant. People could feel free to email me at AOL.com address, and I'd be happy to steer them in the right direction. Just talking to a therapist about it is not going to help.
Yeah, no, that's a great answer.
Yeah, talking to a therapist about it's a waste of time. There are very specific therapeutic approaches.
Hey, Brett, when I think when you turn away from your computer, you fade in and out, but when you're on it,
okay.
I'm sorry, that's perfect right there. Hey, this next one's a good. Not that the other ones weren't. These are actually all good questions. But this one, first of all, thank you, Dr. Brett. Reading your books has changed my life, not only my trading. And this is what I like. My question is, how do I help a fellow trader who has many years of trading and getting stuck in the same volatile performance? He has an addictive personality and acts like a reckless gambler, but is very accurate most of the time, only to give everything back when he gets mad or misses something. So he said this is a question on advice to help someone else. I think that's awesome.
Yes, it shows real caring, and it's a great question. Um, the key phrase here is addictive personality, and acting in that reckless fashion. And so if we look at how people work on addictive behaviors in other areas, whether it's drugs or alcohol, uh, that will give some clues as to what would be helpful with respect to the trading. In treatment for addictive problems, there ends up being a techniques that increase awareness of not only the addictive patterns, but their costs, their consequences, and, and then teaming up with someone, like in AA, teaming up with someone to deal with situations in real time where those addictive patterns occur. And it's typically not something that someone can just do on their own. And so the question is a great one, because someone could be very accurate most of the time. They could have real talent, and addictive pen, you want to have some professional help for that, both with counselors deal with addictive patterns, but also there are some medications, some newer medications that can be very, very safe and very helpful for controlling impulsive behaviors.
This next question is for both of us, and I'll answer it in 10 seconds. Just wondering what both of your opinions on why gold isn't behaving as a defensive safe haven like it normally does. In my opinion, sometimes when it gets bad, people don't want to own anything. And so gold has caught a bid at different times when the stocks have gotten hit, even during this fear. But my thing is, in 2008, there were times where everything went down. People didn't want to own anything. And that's maybe the reason why it's not the safe haven that people will use treasuries for, and the yen with the carry trade functions of it. But that's my limited opinion in it. Do you have one, Brett?
Yes, I think the safe haven is perceived. The safe haven is perceived as investment grade fixed income. And so that's why you've seen this remarkable rise in bond prices, collapse in yields.
Yeah, right.
And even in the corporate sector, in investment grade fixed income. Those are really the safe havens people are looking at.
And you get companies that mine gold get beat up. They're guilty by association being as a stock. And so gold, follows suit with that, I think. But you can't, your best safe havens are the ones Dr. Brett just said, your treasuries, especially on rapid moves in them, that you don't want to be in this environment. You don't want to be long S&Ps if the bonds quickly rally. And sometimes you'll get moments of that. You got to be uncomfortable if you see something happen in the ancillaries, especially on the day trading side. We've got a few more minutes, and I want to make sure I get to just a couple more questions, but these are certainly some really good ones, and I haven't skipped over anybody. I'm pumping in everybody's question right down the roll here. Here, this is a good one. I'm sorry. Couldn't find them. People are just commenting on how good some of your answers are. I'm reading through that. Here's one. Describe the trading process, steps you teach or work with for a setup, especially any mental cues.
That
might get into too much detail, but if you could just...
I actually don't understand the question. The process steps you teach or work with for a setup. The people I work with do not trade quote unquote setups. That whole idea doesn't compute for people in the professional trading world. What they are trading are ideas. And some of those ideas may have a grounding in technical work. Some of those ideas may have a grounding in macroeconomics. Some of them may be grounded in changes in monetary policy, but people are trading ideas. What they then do is use the quote unquote setups to execute those ideas, execute trades based on those ideas that give them a favorable reward relative to risk. So what we're calling setups is really part of how we express the idea underlying the trade. The setup isn't the trade itself. It's our way of implementing the idea behind the trade. That's a major factor that differentiates people in the hedge fund world, for example, from people who are true scalpers.
It's the ready, aim, fire approach instead of every certain thing has to line up. And what I try to tell people is the same thing. What gets you what idea gets you bullish? And then what gets you long? And then where's your risk and all that together? And I think people are oftentimes looking for, when I see A, I look for, I got to have A, B, and C. And then I have a trade. And even if their A, B, and C are great, they still won't trade it. People fail their strategies or setups before their setups will fail them anyways. So I think that's profound in what you said. It's ideas that they're trading. And then they have qualifications of those ideas. I have an idea to get long, but that doesn't mean anything until I have the qualification of when to do it. And then when am I wrong with it? And that could sometimes come quick. The next one I actually posted here, very consistent pattern of losing first one or two trades and then settle down and dig out of the hole. Is this common, and what do you normally recommend to correct this?
Yeah, very interesting question. And I found this in my own trading. I trade the S&P futures, and I found this in my own trading. And the key variable in my case was simply time of day. When I was placing trades very early in the regular New York session, I wasn't giving enough time for the fresh supply and demand to play itself out. And so you have at 9:30 in the morning Eastern time, you have your buyers, you have your sellers, and you don't necessarily see clearly who has the upper hand. As the morning session progresses, it's much easier to see that. And so typically my initial trades were too early in the trading session. The supply and demand hadn't really spoken to me, so to speak, at that time. And so I tended to have more losers early on. And I found by waiting and not trading early, or by placing very small trades early on, that I was then able to make money and be much more consistent once the supply and demand became clearer.
Next question. After 7-8 months full time, I'm starting to see some profitability, small, still trading small, able to stay with larger moves, and I'm ready to be a bit more aggressive. Any advice?
Yeah, a great question. And it sounds like this person is focusing on the right things. First, you develop your trading consistency. You develop yourself in terms of a good ratio of winning trades to losing trades, average size of winning trades compared to average size of losing trades, and you trade consistently. Once you have that consistency, and once you've seen what works for you, then you gradually bump up the risk taking. The key word there being gradually. You want to make gradual risk bumps, and you want to do that steadily. You don't want the trading to feel completely different and get you away from what you were doing that was working. So the nice phrase that the questioner uses, a bit more aggressive. And that's what I would encourage, that you bump up the size of the trading by a fixed fraction and get your consistency at that level, then bump it up again by a fixed fraction, get your consistency, and build yourself that way.
I've got one more question for you, and I got to ask it from Mark, because I know Mark a long time, and I'll get mad if I. Well, this ain't from Mark. Good, because I don't want to ask Mark's question. No offense, Mark, but I could say these things about Mark. I know him, and I'm just giving him a hard time, and I'm avoiding asking his questions because they're too long. But this one's not from Mark. This is from someone which I like. Don't know him, but I like his question. He's torn apart. Stay in front of the screen. People tell him to gain exposure to price action. You're done trading and you hit your target. Close down your screens, not to be tempted anymore. I tend not to sit on my hands if I stare at the screen after P&L targets hit, but I also don't want to miss valuable screen exposure. What is your advice?
Why are they done trading for the day? When they say hit the target, do they mean hit a downside loss limit?
I think upside. If you're done trading for the day and hit a target, let's say if they're up money, be done for the day, but then they're like, well, then I lose time to get, screen time. But yet, if they get screen time and they're supposed to be done trading, they're impulsive to trade. So
I've worked with many firms. I've worked with day trading firms, prop firms. I've worked with hedge funds, different types of hedge funds, quant funds, macro funds, equity funds. I've worked with portfolio managers and traders in so many settings over the last couple of decades. Never once have I heard the concept of making a certain amount of money on the day and being done and hitting target. I've never encountered that. I don't understand it. It doesn't make any sense to me. I think that it can make sense if you make good money to then size down your subsequent trading to essentially put a trailing stop on your P&L so that you make sure that you take some of that home at the end of the day. That makes sense to me. But to shut down trading when you're trading well, I've literally never encountered that as an idea.
For a prop firm and same experience that you're having, it was capital preservation, right? So if you're up big, you don't want to give it all back. So do kind of what you're saying.
And if you saw that there was no further opportunity in the market, if there was an objective reason for saying, wow, things have really changed and I don't see any opportunity for the rest of the day. Oh yeah, by all means, go home.
Right.
But you don't go home. You don't stop trading just because you hit a target. What you do is you assess the opportunity set. But I do think it could make sense to say, all right, from here on in, I will trade smaller. That will give me the exposure and price action and help train me in my pattern recognition. But I'll trade small enough that I can always add to my gains. I'll still be taking home a good chunk. That does make some sense to me.
What should dictate you leaving or slowing down isn't what your P&L is. It's what the market is doing. If the market slowed down, it's not as conducive to how it was to make the money, well, then you're done or slow down or whatever. But it's arbitrary to reach a number and be done because the market could still be opportunistic. Just like in a typical day, you leave when it's slow earlier. And days like the last 2 or the last 2 weeks, you'll tend to have guys in prop firms there all day. So the market dictates how long you're in front of your screen, not your P&L necessarily. So
yes, and I do think it makes sense to not just play with house money. Just because you're up, don't take unusual risk or don't get looser in your risk taking. And you might, as I say, size down so that you hold on to a good chunk of your gains. But the time in front of the screens is valuable if you're a developing.
There's no doubt. There's no doubt. It's everybody's got to get the screen time and has to do sometimes things they don't want to do. And I've been talking a lot about this year, and that is at some point you have to build momentum and do what you say. If you look into your screens and for some reason you're not going to trade anymore, well, then don't trade anymore, but you still want the screen time, if that is what you say. But if you're not going to do what you say, at least don't do the opposite. If you don't go work out, fine, but don't also eat chocolate cake. It's 180 degrees different from doing what you say you're going to do. Build momentum, do what you say you're going to do. That's called discipline. And there's a lot of ways to lose that discipline when there's money at risk and when there's your opinion to be wrong at risk. And that's why it's okay to be wrong. I don't care that, listen, 2 weeks ago, I minimized this coronavirus. I'm not sitting here thinking that, oh, why did I do that? I feel stupid. No, I'm the trader in me could flex in and out of it. Pay attention and let the markets tell me how good or bad things are. If there's more questions, Doctor, you guys could email me, Anthony@edgetradinggroup.com. Dr. Brett is one of the most liberal guys with his email address I've ever met. So he's already given it out a couple times. And so he's, and you could follow him on Twitter. I also want to make sure that they know where to get the latest blog book that you put out. What's the easiest way to find that link? I'm going to pop it in here, but people watching this on recording, Brett, what's the easiest way for them to find that link?
Yes, that link is on the homepage for my blog, Trader Feed. So the address is traderfeed, TraderFeed.blogspot.com. And on that homepage, you'll see a link to a free blog book called Radical Renewal, which covers the topic of trading and spirituality, which is a unique topic and one that I think has a lot of promise.
And you mentioned me in it, so how could it be?
There you go. Well, I apologize that I have to leave. I've got some calls I've got to make. I've been putting in some very long days given these market conditions. So I apologize I have to leave, but I will be very happy to respond to emails.
Brett, thank you a lot. This has been great. Good luck with everything, and I'll stay in touch. Appreciate it.
Thank you very much.
All right. Everybody's thanking you as well. Great work.
Thank you.
So I'm going to stick just for a couple more minutes to give people the opportunity to not ask me questions, but I want to give people the opportunity. I don't want to just pop this in the link. If guys want a couple days to be part of the trading room, email me. I'm not going to blast it out to the whole list of people in here. The people who actually will come to listen. I don't offer trials to my room because on my YouTube channel, all the highlights of every day in the room essentially are there. So that's better than a trial. But given this volatility, you really can't get the same than being there. So I'm not going to just give the link out to anybody in this, but I'm going to give my email address. If you're interested in emailing me, say, Anthony, sure, I'd like to have a couple days in your room. I'll do that. And then we could take it from there. So let me pop that email address. It's Anthony@edgetradinggroup.com. For those that are live, you'll see it in your chat. For those that are watching it in recording, I could actually put it on the whiteboard here. And if I listen to my dad and took typing instead of chorus in high school, I'd have put it in here faster. He says, why are you taking chorus? And I said, because it's over at the girls' school across the football field. I went to an all-boys school. Sophomore year, you were able to take chorus to go over to the girls' school. And he says, oh, I get it. But anyhow, email that address. I'll pop in a link for you guys to check that out. Obviously, with all this volatility, you have to be as objective as you can. You have to be centered. You have to know that there's more eyes and ears on what matters is the most important thing. That's why when you listen to Brett talk about the people he worked with, they're always groups. If you think about it, there's not individuals. They're all groups. Groups have to. That's where the success is. It comes in a group. It doesn't come in the individual. And so almost impossible to be successful on this or at this on your own, especially if you're failing. It gets very lonely very quickly. And then it's hard to find the right group also because there's a lot of gurus out there and a lot of know-it-alls, and then there's a lot of forums, and that's not the right group or community. So it's almost impossible to do it alone. That's why you hear him and the people he's worked with. But I thought that he had some really good answers to a lot of questions, and I'm not that I'm surprised that the questions were good, but they were actually better than I thought. And I think I got to everyone except Mark, but that's on purpose. And then the other thing was Dave in the room. He had a good question, and I forgot to bring it up, but I'm going to send it to Dr. Brett and go over that answer with him. But that was like the leadoff question I wanted to do, Dave. I'm going to have to email and get a more personalized answer from him, but it'll be just as good. These questions were great. I hope you guys got a lot out of other people's questions. I did. Usually I don't care about other people's questions. I'm not being selfish. It's just a distracting type thing, right? There is no such thing as a stupid question unless it's someone else's. But not today. Today there was some great questions, and I could tell the people who came here are doing this, and they're serious about it. So that's cool. As far as like a lot of the opinions that Dr. Brett expresses or we express on this coronavirus, we're not medical doctors, right? Let me preface that. And this is just about what we see and what you guys see and what you hear and everything like that. So I don't want people taking away that either one of us are pros in that, because that's a whole different animal. But the thing is that I minimized this in the first week or two, and I kind of questioned the mischaracterization word that China started using 2 weeks ago. And then it didn't surprise me as we got hit. And now it's like, this market here, let me show you guys something really quick. Let me share this screen. I started showing you and Brett had arrived. But this is kind of confusing because it tightens up, and typically I don't need to put overlays on it, but this is the bonds and this is the S&Ps. And if I just close down the yen, you could see when one goes in their highs, the other one is at their lows. All right. And so it's like, that's not a coincidence. This thing grabs a bid, then they sell off the S&Ps. And these aren't little sell-offs, by the way. This is from 28.60 to 28.25. It's a 30-something point break. So there's no coincidence when one goes up, the other goes down. And there is a lead lag when it's faster. Not every time, but there is. So it's important to watch more than one market all the time, but especially in these markets. It could give you the idea in the trade all in one. So I want you to look at this. This is a daily chart, just something simple. You see how this was the beginning of the coronavirus, right? And they come back from it, and they could rally all the way back to where they were. And we said it's still 50% lower than where they came. They got a lot of wood to chop. And then this became the Fed. The Fed pumped in, half a point cut and everything else like that. And then all of a sudden, when you can't stay bullish on all that injection and everything, at some point, the bottom falls out. Now, the last couple of days have been to the extreme and had a lot to do with the price of oil. And the price of oil and that price war had to do with coronavirus. So it's been a domino effect. But I want you guys to focus on something. Brett's answers kind of got me excited and talking here. So I hope that what I'm sharing with you guys is helpful. But let me just explain something here. You've got an economy that was, let's just say, this strong. It's not going to be, if that's how you measure the strength of the economy before the coronavirus, it's going to be smaller, all right, post-coronavirus. It's how smaller is it going to be? That's the problem. That's what the market is worried about. The carnage after the hurricane passes, what kind of damage did it do, right? And you truly don't know until the waters recede. And the waters have not receded. The hurricane clouds are still above us. So how much smaller is the economy is one of the reasons why it's on eggshells. Now Brett brought up an interesting point about, and I talk about it daily in the room, and I've been showing this for look at some of my tweets talking about it was a matter of when the Fed was going to cut a half a point. And I showed that Fed fund tool and how the Fed went from obviously not doing anything to cutting a half to cutting a full and everything else as this corona really started to get weak in here. But the point I'm trying to make is that there could be some really aggressive interest rate intervention, QE, liquidity, injections, things that if the box is a little smaller could help get it back to where it was sooner rather than later, at least from a perception standpoint. So this could bail out a lot of the fear and unwind it. But I really think you have to get on the other side of the mountain with this coronavirus. And is China, it seems like if their numbers were actually known to be accurate, then I think they're on the other side. But again, this is the reason why we had this double, the real big sell-off was because of their word, well, we mischaracterized the way we're reporting cases, which is another word for lying. Daphne, nice to see you. I'm reading some of your guys' comments from since Brett just left. All right, so again, pay attention to what to anticipate coming down, press conference by the task force, by President Trump, by the Democrat. Are they going to push legislation? March 17, 18 is the two-day Fed meeting. They even come in before that to announce something. Do they pull something off? He mentioned the word TARP. TARP was Treasury asset something purchases, but it was about $800+ billion that came out of nowhere in September that really had to address, or things were going to look pretty ugly in mid-September. Overnight lending was locking up in September of 2008, and that's where Bernanke and Paulson went to 7 or 8 leaders in Congress and said, here's 6 pages of what we need, and it's about $800 billion. And they go, oh, we need more than that. Okay, you need more than that. You're going to wake up Monday morning and you won't have an economy to save. Now, is it that bad? No, but they could introduce something that has the market say, interesting. And that's the moment you don't want to be stuck short for. And so you got to be flexible, keep yourself safe. Hopefully this is contained a lot better than it was and did in China. But don't panic. Just be aware. I got a new saying for you guys. Instead of beware, be aware. And I think that's a big difference. Most people are not aware of their surroundings, and that's why they have to beware all the time. So be aware of what's going on, and not just because of this virus, but because of these markets. Volatility is opportunity, but you got to know what you're doing. And if you have struggled before this, trade small or just listen and, don't even sim it, because that's going to create bad habits. And don't even micro, because you could lose money in the micros. You could lose a lot of money in the micros with this price action. But if you haven't made money in trading, volatility is the place to start, because you're just going to take flyers. You're going to end up taking a flyer, and you're going to add to it, or it's going to go your way. Hey, this is great. I made 30 points. And then you do it again, or you do it, so just, you got to be careful. It's not, you don't go from no football to pads. In trading, now they got this thing called the micros, which is like flag football. You can learn a lot about the game without having to get your brains beat in or before you put on the pads. And so, but not in the micros, it's like tackle football. So you got to be careful. Just be smart, and don't give yourself too much credit, because you never know what you're capable of when what hits the fan, both in good and in bad. So people will fade their strategies before their strategies fail them. Have good ideas. All right, guys, I did record this. Give me time to render it and have it put up. But again, email me if you want a couple days in the room and you actually come. And that's why I'm not just posting it in here. I prefer people to take that step. And we'll go from there. So have a safe night, guys, and we'll see most of you guys in the room tomorrow at 8 Central. Hey, Dr. Raj, could you hang on for 1 second? I want to type in something to you.